Okay, the second trade that I find very interesting right now really is embedded between the relationship between future options implied volatility for yen futures and the interest rate differential between dollar yen. If we look at historical implied volatility of yen future options, it really lies between 5% annualized to 15% annualized, and today we see it at around 9% annualized. However, the premium in the term structure due to the interest rate differential is about 6%. Now, why is that important? Future options trade on their corresponding future, meaning that a 1-month option trades usually against the 1-month future, and a 1-year option trades against the 1-year future. Now, normally, spot or cash market volatility isn't necessarily a good proxy for long-dated volatility. You see this a lot in VIX futures. Think about VIX futures for a second. Long-term VIX futures are really going to be anchored closely to long-term median vol, while short-term VIX futures or cash VIX is very subject to right now volatility, and so it can flip from contango to backwardation extremely quickly. So you could see a rally of say 100% in the front month future in VIX futures, but essentially barely any movement in long-dated futures for VIX futures. This means the dynamics of the term structure are extremely fluid and flexible. You can see the same types of dynamics in commodity futures as well. Remember when COVID-19 made oil go negative? Well, front month oil delivery or immediate delivery was negative because there wasn't any place to store oil today, right now. But longer term oil futures, 1 year out, 2 years out, was anything but negative. It reflected more normal supply-demand dynamics and didn't move as drastically because right now delivery of oil isn't necessarily fungible to 2 years from now. There's a lot of storing and holding and moving through time to get it to 2 years out. So the dynamics of the term structure in commodity futures as well is extremely fluid and subject to kinks and different backwardation and contango cycles. Now this brings us to financial instrument futures and forwards. Now the thing that's very interesting about financial forwards and futures is that outside of carry costs, financial instruments are a lot more fungible, which means that the term structure is a lot more rigid. 2022 had one of the biggest interest rate hike cycles in the United States, and what we saw is that the yen crashed a lot in response. And although the term structure steepened, there was a parallel shift lower in the value of the yen across all expirations. So why is this interesting? Well, the opportunity that I see here is that you can actually buy at-the-money options 1 year out on yen futures that, all else held equal, will actually expire in the money by a greater intrinsic value than the extrinsic value you paid on onset. Essentially, it means that the time decay of the option is offset by the futures roll down or the interest rate differential that currently occurs. This type of situation is not an arbitrage, but there is a lot of value there. Essentially, it allows you convex exposure without needing to pay for it. Again, all else held equal, the futures price roll down to spot will be by a greater magnitude than the implied vol or the extrinsic price that you paid in terms of vol for the at-the-money option. This type of situation is rare because it has two really important components: a low volatility asset class and an extremely high interest rate differential that's being priced into the term structure. And unlike the VIX or commodities, should the value of the yen change, the term structure is not as fluid. The back end will also move in a near parallel fashion. Not exactly parallel, the front end will move more, but in a near parallel fashion. So that's the second trade that I find really interesting, is long dated future option puts on the yen.